What it is my debt to income ratio is high due to student loans. My credit score is around the 800s. I owe 75,000 in student loans. My plan was to actually sell my house and to get a bigger house, but I was going to put a large down payment on the new house and not pay towards my student loans. So, does the ratio you just showed far as mortgage work on student loans? If so, that's good. And then the fact of should I actually put a large down payment on a new house?
All right, Takara. So what we're going to do, Takara, number one, let's just talk about student loans. You can see what we're talking about. Small amounts of money can save you tons of interest on your student loans. The average person on our program using this system pays off their student loans in 5 to 7 years. I don't care how big they are. All right, that's number one. Number two, all right, so you were thinking about putting a large down payment on a loan, right? So we're going to put this on the screen. Give us an idea of how much house you want to buy.
300,000.
Oh, goodness, we're already there. 300,000, okay? And you're thinking about putting how much down on that house?
150,000.
So you want to cut it in half.
Mm-hmm.
All right, so listen, let me show you what happens when we do that and how this is actually sold, folks. So we're going to duplicate this tab, and let's say we're going to use a 3% interest rate across the board so that we can see. When you're contrasting whether to put a large down payment on or not, the numbers that are used are based on a 30-year loan, okay? So if you get a $300,000 mortgage for 30 years, this is what it's going to cost you. If you get a $150,000 loan for 30 years, this is what it's going to cost you. All right. And so that's what we're going to take a look at. So we're going to put in $150,000 over here, 150,000 over here, 360 months. All right. 150,000 over here. And then back over here, we're going to put in $300,000 over here at 360. Boom. Take that out. And then here's our payment on $300,000 is $1,264.81. And then if I have $150,000, I could put down, oh, look what my payment would be. My payment would be at the same interest rate, $632. So we're going to contrast these two 30-year loans, Takara, right on screen here for you. All right, so we're going to go back. We're going to take it step by step, and we're looking at $1,264.81. So here's the first thing I would ask a client. If you got the $300,000 loan, could you afford to make the $1,264 payment?
Yes.
And then the next question would be, well, why would I do that, Don? If I could put $150,000 down and have a $632 payment. All right. So already the $150,000 loan is winning, correct?
Correct.
All right. So now we're going to move down into the summary on both loans. So in the summary, we're going to find out on a 30-year loan, the bank wants $155,331.60 in interest on that loan. But if we put $150,000 down, then over 30 years, the bank wants $77,667.60. Oh, big difference. Big difference. So far, the $150,000 plan is working. All right. So I'm putting on the screen here a calculator. So we're going to put in 55,000. This is how it's sold, folks. $155,000 and 55,000, 331.6. All right, 60 cents. And then we're going to subtract from that the $77,000. And let me put my calculator back on the screen. Okay, we're going to subtract from that 77,667.60 equals, that's a savings of $77,664 by putting your $150,000 down, isn't it, Takara?
Yes.
Now, that's how it's sold, and that is the attractive part, isn't it?
Yes.
But I'm going to tell you, you need to get the $300,000 loan.
Mhm.
If you get the $300,000 loan, then where is your $150,000? You still have it, don't you?
Correct.
Okay. So if you have the $300,000 loan, Takara, if your only choice was pay it as a down payment, now that you have $150,000, when you make your first payment, what could you do with that $150,000 you have sitting in the bank when you're making your first payment?
On that pay towards the principal.
Could you pay it towards the principal? Yes. Let's see what would happen if you did. I'm going to take my $150,000 now. When I make my first payment, I'm going to apply that to principal. And when I pay down this loan by $150,000, will I still have a $150,000 loan if I pay it as a prepayment? Will they subtract $150,000 from what I owe?
Yes.
And then I will still owe $150,000, wouldn't I?
Correct.
All right. Now, on this loan, I have $150,000 for 30 years set up. Okay. So 30-year loan for $150,000. What would happen if I take my $150,000 and add it to my $300,000 loan for 30 years? We're going to go to cumulative principal and we're going to go down to $150,000. All right. So we're at about $150,000. We just took off 220 payments off a 30-year loan.
Mm.
So if we take that 220, let's clear this out. 220, divide that by 12. That's over 18 years. You just knocked off a 30-year mortgage by applying it as a prepayment instead of a down payment. So
Got it.
now I've got 18 years. I've got what, a 12-year mortgage now?
Mhm. All right.
Does that make sense?
Yes.
We were saving $77,000 the other way, right?
Mm-hmm.
And this way, we've already saved what? $127,000 in interest we never have to pay in just 1 month. And that $77,000 we were going to save was going to be over 30 years. So all those numbers they were telling you are based on a 30-year loan if you keep it for 30 years. They're not talking about this. What if I take my $150,000 and put it down as a prepayment and knock off 18 years right off the bat? So now I have a $150,000 loan for 30 years, or I can have a $150,000 loan for 12 years using the same money. Takara, which one is better?
The 30 years. I see.
And then put that $150,000 down as a prepayment. Never, ever, 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 ever do it as a down payment.
Got it. Thank you so much.
You are so welcome. Was that valuable to you?
Very.
Do you know the basics of this is actually in my book? Folks, you need to get my book today. All right?
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L. method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.